Hello everyone and welcome to a new video. Today we're diving into a topic that sparks a lot of debate among investors. What is better, passive or active management? Whether you're just starting to invest or already have some experience, you've probably heard these terms, but you might not be clear on what they mean or which is the best choice for you. In this video, we'll explain what active and passive management are, compare their pros and cons, share practical tips to help you choose the option that best fits your financial goals. So grab a pen and let's get started. What is active management? Let's begin with active management. Active management involves a professional manager or a team of managers making decisions to buy and sell financial assets like stocks or bonds with the goal of outperforming a benchmark index such as the S&P 500 or the FTSE 100. Think of the market as a giant investment supermarket. An active manager is constantly searching for the best products, stocks, bonds, etc. they believe will increase in value while avoiding those they think will drop. They rely on analysis, research, economic forecasts, and sometimes a bit of intuition. Advantages of active management. Potential to beat the market. If the manager makes smart choices, you could earn higher returns than the market average. Flexibility. Managers can adapt to market changes, like economic downturns or emerging trends. Professional expertise. You have experts working for you, which can be reassuring if you lack the time or knowledge to analyze the market. Disadvantages of active management. Higher costs. Actively managed funds typically charge higher fees, known as the TER, total expense ratio, often ranging from 1% to 2% annually or more. Risk of human error. Not all managers are infallible. Many fail to consistently outperform the market. Unpredictability. Even expert managers can't predict the future with certainty, and the market can be volatile. Here's a key stat. Studies like those from S&P Global show that over 80% of actively managed funds fail to beat their benchmark indices over the long term. This doesn't mean it's impossible, but it's definitely a challenge. What is passive management? Now let's talk about passive management. Passive management aims to replicate the performance of a market index, like the S&P 500, MSCI World, or Nasdaq. Instead of trying to beat the market, these funds simply track it. For example, if you invest in a fund that tracks the S&P 500, your investment will rise or fall in line with that index, which represents the 500 largest US companies. Passive management gained popularity thanks to figures like John Bogle, the founder of Vanguard, who argued that most investors achieve better long-term results by following the market rather than trying to outsmart it. Advantages of passive management. Low fees. Passive funds like ETFs or index funds typically have very low fees, often between 0.1% and 0.5% annually. Consistency. By tracking an index, you eliminate the risk of a manager making poor decisions. Diversification. Passive funds usually include a wide range of assets, reducing the risk of concentrating your investment in just a few companies. Disadvantages of passive management. No aim to beat the market. Your returns are capped at the market average, no more, no less. Market risk exposure. If the index drops, your investment will too, with no one actively trying to protect you. Less excitement. For some, passive investing might feel boring since it doesn't involve active decision-making or big bets. A key fact, according to Morningstar, passive funds have grown in popularity because they tend to deliver better net returns after fees than many active funds over the long term. Direct comparison. Now that we understand both approaches, let's compare them across 4 key factors: performance, costs, risk, and effort. Performance. Active management has the potential for higher returns, but data shows most active funds don't outperform their benchmarks over the long term. Passive management offers predictable returns aligned with the market. If the index grows 7% annually, you'll get roughly that return minus fees. Costs. Active management. High fees can eat into your profits, especially during periods of low returns. Passive management. Low fees help you keep more of your returns, which is crucial for long-term investing due to compound interest. Risk. Active management depends heavily on the manager's decisions. A mistake can lead to significant losses. Passive management. Risk is tied to the broader market. If the market falls, so will your investment, but diversification reduces the impact of any single company. Effort. Active management requires trusting the manager or, if you're investing on your own, dedicating time to research and decision-making. Passive management. Perfect for those who prefer a set-it-and-forget-it approach. You invest in an index fund and let the market do the rest. In short, active management is like driving a race car. It can be thrilling and lead to big wins, but it requires skill and there's a risk of crashing. Passive management is like riding a train, more predictable, less expensive, and gets you to your destination with minimal effort. Which is better for you? The big question: active or passive management? The answer depends on your goals, risk tolerance, and the time you want to dedicate to your investments. Here are some guidelines. Choose passive management if you want simplicity and don't have time to analyze the market. You want to minimize costs and maximize long-term returns through compounding. You're okay with earning the market's average return and prefer a diversified approach. Example: if you're saving for retirement in 20 or 30 years, an index fund like the MSCI World or S&P 500 can be a great choice. Choose active management if you believe you can identify managers or funds with a strong track record of beating the market. You're willing to pay higher fees for the chance of higher returns. You're interested in investing in specific sectors or markets, e.g., technology or emerging markets. Example: if you have advanced knowledge or trust a specialized manager, you might try an active fund in a sector you understand well. Practical tip: you don't have to pick just one. Many investors blend both strategies. For example, you could put 80% of your portfolio in passive funds for a solid foundation and 20% in active funds to chase specific opportunities. In summary, there's no one-size-fits-all answer to whether active or passive management is better. Passive management is usually the simpler, cheaper, and more effective choice for most investors, especially over the long term. But active management can make sense if you're really seeking something specific and are willing to take on higher risks and costs. The key is to define your financial goals. Assess your risk tolerance and choose a strategy that lets you sleep soundly at night. So, what's your preference? Active, passive, or a mix of both? Share your thoughts in the comments, and if you enjoyed this video, don't forget to like, subscribe, and hit the bell to stay updated on our next personal finance tips. See you in the next video.